Okay, so for a deep dive into the last board meeting of the year and where rates go from here, I'm joined by economist Paul Bloxham from HSBC and Mike Bowie from AMP. Look, Paul, want to start with you. Was the big surprise that the rates are definitely rising next year?
I think the big thing was in the press conference where the governor told us that they had talked about what would need to happen for them to be able to need to lift interest rates. I think the other thing for me is if you look at the statement and the information they provided, they said there was upside risk to inflation and then told us all these reasons why that was the case. And I think, growth is in an upswing, unit labour cost growth is too strong, inflation's obviously above target already. I don't think there's anything in there that tells me that inflation actually is going to head back towards the target band, to the midpoint of the target band. I don't think there's anything in there that convinces you that there's a disinflationary impulse. So I think the RBA is going to be lifting interest rates next year. That's our view. We think they'll be lifting rates by the third quarter. And I think there's a tangible risk it might come earlier than that. We could be thinking about rate rises in the first half of next year. Yeah, we probably can put up a chart showing rate hike odds for next year. But Bowie, when do you think rates will be going up in 2026 and when might that be?
I mean, I totally agree that the next move in rate would probably be a hike. I think every economist is agreeing with that now. But I guess the uncertainty is definitely in the timing. I'm not sure we can actually see a rate hike next year because actually in today's statements, the RBA governor and the RBA board also acknowledged that there's a lot of uncertainty in the new CPI measure. As everyone knows, we've actually just had a month of that new CPI measure. There's a lot of issues with that seasonal adjustments in there. And the new trim to mean measure is actually not really comparable to our old history of quarterly trim to mean. So I think there's a lot of uncertainty in there. I'm not sure if we're going to see persistent underlying inflation pressures in a lot of the market services sectors, which is what the RBA is worried the most about. So everything really depends on what inflation numbers come out in next year. Our view is that we're probably going to see a rate hike, but maybe early in 2027. Yeah,
well, thinking about later this month, we've got Christmas, we've got spending, we've got the new year, people travelling, flying overseas, holidays. That's all inflationary.
That's right. I think two things. I think the first thing is we've seen inflation already pick up. So the third quarter print was a higher inflation reading and we are already above the Reserve Bank's or at the top edge of the target band on a core basis. But the main message that I have is not so much about the inflation numbers themselves, but actually the economy itself doesn't look as though it's going to deliver more downward pressure on inflation. Growth is already running above trend, in my estimation.
Above 2%.
Capacity utilisation, that's right. We think the speed limit for the economy is very low, or lower than it's been, because productivity has been weak. Capacity utilisation, we've got a print of that today. It rose again, and it's well above its average. The unemployment rate at the moment is still below what the RBA calls full employment. And the cost base in the unit labour cost measure is running above what's consistent with the inflation target too. It's not so much that the inflation measure itself, in and of itself, is we're looking for it to come, for signs of whether it's tangible or not. There's just no mechanism in the economy, as best I can see, for putting further downward pressure on inflation. And so the only way I think you get there is for the RBA to be lifting interest rates, and I don't think they're going to be able to wait that long. I think it's going to come in 2026. The other mechanism, the other way this could happen, is if the government was to do a bit more trimming of its own spending. I think that, if we saw some fiscal tightening, but I'm not assuming that we're going to get much.
And we'll get the MyPhone next week as well.
That's right. So we'll see whether the government does take that opportunity to think about doing a bit more fiscal tightening, because fiscal tightening rather than monetary tightening could be one way that we get a bit more disinflationary impulse into the economy.
Now, I want to play you both a quick grab from the press conference. It's Governor Bullock talking about rate hikes and the view from the Monetary Policy Board.
What I would say at this point is what we know at the moment. I don't think there are interest rate cuts in the horizon for the foreseeable future. The question is it just an extended hold from here, or is it possibility of a rate rise? I couldn't put a probability on those, but I think they're the two things that the board will be looking closely at coming into the new year.
So, Mike Bowie, later this week we're going to get the unemployment figures as well. The labour market's been pretty tight. We've heard the governor mention that in the statement. I mean, what are you expecting to see on Thursday?
I mean, I think this is where our key difference between our view and the RBA view. It really shows that economics is more arts than science. I know that the RBA has been saying that the labour market is a little bit tight. We think actually it's around balance at the moment because the evidence is that wages growth, according to the WPI, which is the wage price index, that's the purest reading of wages that you can see, that's actually ticking down. If you look at advertisements, job ads online, you see that wages are ticking down there as well. And a lot of the rises in employment over the last few years are definitely from the government sectors. You have started to see more cyclical sectors increasing in jobs, but that hasn't really picked up to the same extent that it has back in 2022. So we think that the outlook for jobs is actually going down from here. We think that the unemployment rate would tick up slightly to around 4.4% this week and maybe tick up to around 4.5% next year.
Mm-hmm. And there's now an 8-week break until the next board meeting. So that's a lot of time for the RBA to watch and see what happens with the economy over the next 2 months.
Well, that's what they're hoping for. I mean, I think there's a lot of hope in this. The RBA is hoping that the next inflation numbers will start to show some easing and that some of that pickup in the big pickup in the third quarter print will prove to be temporary, and that inflation will therefore come in just low enough that they don't actually have to lift interest rates. But I think there's a bit more hope in that myself than actually what's likely to happen. I think we're going to see inflation remain a bit too persistent, and the question's going to be, how the RBA decides to respond to that. I think interest rate rises in 26 are likely.
And we can probably see a rate cut from the Fed this week. Our economy now seems to be in a very different position to so many others around the world that are cutting rates.
Yeah, I mean, to be fair, it's actually not in a bad position at all. If you look at 2.1% growth, that's actually the fastest pace that we've seen in 2 years. Whereas if you look at the US, you are actually seeing a more prominent decline in jobs growth. Whereas again, our jobs growth is kind of muddling along. So I wouldn't be complaining about that. To be fair, if you see that rates are being held in the near future, that means that maybe we are at the right position for rates as well as for the economy as well.
My Bui from AMP, great to talk to you. Paul Bloxham from HSBC, thanks for coming on the show.
Thank you.
Thank you.